sorry for being a little bit late. The IT was playing up. So I'd like to welcome everyone to this multi-location, that is, hybrid meeting of the Pension Committee, which is open to the press and the public on request. This meeting will not be broadcast live. However, a recording will be made available as soon as possible after the meeting has concluded. As ever, we welcome the use of the Welsh language at meetings, although I've had no requests from anyone to speak Welsh today, so the meeting will be conducted in English only. May I remind members that as per statutory guidance made under Section 4 of the Local Government (Wales Measure of 2011 and our formally adopted hybrid meeting policy, any member attending a meeting remotely must be able to be seen and heard by the members and officers who are attending the meeting, as well as by members of the public viewing the meeting. So can I ask that you all please use your cameras for the duration of the meeting. Please can members attending via Microsoft Teams refrain from using the chat function and instead use the raise hand icon to indicate when you would like to speak. Lastly, please remember to keep your microphone muted when you're not talking. So, moving on to the agenda. Agenda item number 1 is attendance and apologies. Jade.
Thanks, Chair. I've not been made aware of any apologies.
Can I give apologies for Councillor Alfie Best, please?
I'll note that.
Thank you very much. Moving on then, agenda item number 2, declarations of interest. And that's also back to Jade.
Thanks, Chair. So starting with Councillor Hawler, I have that you're a contributor to the fund.
That's correct, thank you.
Thank you. Councillor Keat, just to confirm there's no declarations for yourself.
Yep, correct.
Thank you. Councillor Williams, I have that yourself and your wife are both in receipt of a pension and contributor to the fund.
Correct.
Thank you. And then yourself, Chair, I have that your father and 2 other family members are in receipt of a pension and you're a contributor to the fund.
Yes, that's correct.
Perfect. Thank you.
Thank you very much. Moving on then is agenda item number 3, minutes of the Pensions Committee from the 17th of March 2025. This is for members to raise any issues and to agree the minutes. So looking in the room, David, and looking online to both Stuart and John, does any member have any issues they'd like to raise? If you do, please put your raise the icon online. Everyone happy? Yeah, great stuff, in which case I can take those as agreed. Item number 4. This is for information only. Draft minutes of the Pension Board meeting of the 29th of April 2025.
All right.
That's missed on me, isn't it? So, as Ian, you're here, is there anything from the board meeting you'd like to...
No, Chair, nothing to add, thank you.
Right, then, in which case, everyone happy to note these minutes? Yeah. Yeah, great, cheers. Thank you very much. Moving on then, first, a substantive item of the agenda is agenda item number 5. It's the administration update that starts on page 37 of the consolidated pack. I'd like to hand over to Jo.
Thank you, Chair. The first part of this report discusses some staffing changes that have happened within the section and are continuing to happen over the forthcoming months. So our current operations manager will be taking flexible retirement on the 30th of June and then move from their current role to the MacLeod project team. This allows us to retain an experienced member of the team with extensive knowledge of MacLeod and LGPS regulations. Tracy Morton has been appointed as the new operations manager, and she has over 30 years' experience within the fund, and she previously held the position of benefits manager. And Matt Cox has been appointed as the benefits manager. So we have a vacancy at the moment of team leader, Matt's previous role, and we'll be hoping to advertise that shortly. As we know, changes in structure can be disruptive to team members. However, this is an opportunity for members within the team to progress and develop further within the fund. So we see it as a good opportunity for all individuals affected. Moving on then to My Pensions Online. So as you can see, point 5 of the report talks about the number of members that have registered for My Pensions Online. So that continues to increase, which is very pleasing. Just an update outside of the report, just to discuss Engage. So My Pensions Online will be ceasing at the beginning of next year. And we need to migrate to a new Engage system. So this is still hosted by Hayward Pension Technologies, but it's a new system. It'll have a new look and feel to it, and it'll also be more user-friendly. As part of the move to Engage, there will be video annual benefit statements, which I think will be a great benefit to our members. There'll also be electronic identification and multi-factor authentication. So we are starting the implementation process now with a view of going live around July, which would coincide nicely with our annual benefit statements in August. So hopefully then we'll be able to get more members signed up to Engage and going forward. So I'll keep you updated on how the project is developing as we progress through that. Just to touch on McLeod, so as you're aware, the fund continues working on business as usual McLeod work, and to assist with additional work, we've also appointed 2 additional temporary members of staff who started in the past few months. They will join the fund and work on benefits work, freeing up members from the benefits team to move across to the McLeod team. So that should help us with the McLeod project. Another project that's ongoing as well is the pension dashboard. So members have had updates on this in previous meetings. So the pension dashboard is a government initiative to help individuals access information about their pensions online, all in one place. And the fund's required to join the dashboard by the 31st of October. In order to connect to the dashboard, we require an integrated service provider, an ISP, which facilitates the connection between the pension scheme and the dashboard. So we've procured Hayward Pension Technologies ISP, and the implementation takes place in 2 phases. Phase 1 was completed in January 2025, and now we've begun Phase 2 implementation, and that should take around 4 weeks to complete. And that was all the updates that I had. I invite any questions.
Okay, thank you very much, Joanne. Now, David's already indicated in the room, so I'll take David first, and then I'll come to members online.
Thank you, Chair. Joanne, thanks for the update. Just 2 slightly related points, really. Firstly, if you're migrating to a new system, are you going to cease promoting My Pensions Online? Because obviously it seems a bit daft if people are going to migrate. And secondly, do you find that taking forward any of the roadshow type sessions leads to that? Is there a correlation between we're promoting things a bit more and sign up?
Thank you. Yes, we will cease promoting My Pensions Online when we come to that stage where we're ready to roll out Engage. What we do have, and Alex and I have had conversations about this, is the importance of advertising this and doing a campaign to members to notify them of the new system, how it's going to impact them, and a lead-in time to when we actually do go live with Engage. And we're hoping to utilise the skills within the council, their communication team, to hopefully develop and drive that forward. And we do find that when we do advertise My Pensions Online, especially around the July time with the annual benefit statement, that the numbers of members registering does increase significantly. So that is something we're very conscious of. Our aim is to increase the number of members signed up to My Pensions Online anyway, and that will roll forward then into Engage. And we want to give members as enough information as possible and incentive to register for Engage once we roll it out.
So I've got a supplementary there, but I'm happy to take any questions either John or Stuart might have. Before I say anything, John, nothing? Stuart, I can't see, but if you jump back on, I'll take that as a yes. Okay, my supplement is just for clarification. The new platform, is that something that government is now asking everybody to go on? Yeah, the dashboard. Sorry, with the pensions, with the pensions dashboard. The government has been encouraging everybody to go onto the dashboard, but now we've got to go onto a different platform instead.
No, so the dashboard and Engage are two separate systems.
Yeah.
So Engage is our pension fund system to members access only their pension with us. And then we'll also have the dashboard will just sit on top of that, where when members log in, they'll be able to view our pension, but also pensions in other places.
So, yeah, so we're moving from My Pensions Online to Engage, and then the dashboard will at some point, in theory, on the Never Never, will actually come into being.
Yes.
Right.
Yeah.
Question then, why are we moving, what's the rationale for moving from My Pensions Online to Engage? And I know you told me before, but I can't remember.
Basically, it's end of life. So Hayward Pension Technologies will provide it, won't be supporting it after January. And this system does give us a lot more functionality as well, which should be better for members.
So essentially, it's a commercially dictated decision. Fine, okay.
Yes.
That's all. Stuart, you're back. Any questions on this item?
I don't know if you can hear me there, Nathan. Apologies. I'm having all sorts of problems with my camera at the moment, but I can hear everything's been said. So I'm trying to sort the technicalities out at the moment.
Okay, good luck. In which case, moving. Another point. Going back to your first, the first item on your report there, Joe, talking about the phased retirement of a single member of staff. It's Karen, isn't it? So it's Karen Peplow, who's been here for a very long period of time. Can I just ask that we note the thanks to the committee in the minutes, please, for all of Karen's hard work. In which case, moving on then, can I point members to the recommendation at paragraph 9.1 on page 38, which I believe is that we note this report. Is everyone happy to note the report? Excellent, fantastic. That is then carried. Agenda item number 6. This is the quarterly investment performance report to the 31st of December 2024 that starts on page 39 of the consolidated papers. Can I ask David McFadgen, who's the Finance and Investments Manager, to deliver his first item to the Pensions Committee, please?
Thank you, Chair. Good morning, everyone. So as the Chair said, starting on page 39, the purpose of this report is to report the pension fund investment performance for the first 3 months of this year. So I'm going to cover some key messages, an update on the market in Q1, the fund performance by asset class in Q1, an update on the fund value and asset allocation, a reminder of some longer-term performance, and an update on private market positions. We'll also just touch on Q2, and then I'm going to hand over to Aoife, who's sitting across from me. She's going to give a bit more colour to the context of the markets in Q1, and actually probably a little bit beyond that as well, I suspect. So in terms of key messages and the big picture, the fund posted a return of minus 1.34% in the first 3 months of the year, and that actually underperformed our benchmark by 22 basis points, so the benchmark was minus 1.12%. So this equated to a decrease in fund value of around 57 million, and at the end of March, the fund stood at £4.435 billion. Over the past year, so that's the 12 months to the end of March, the fund returned 5.16%. That's also behind the benchmark return by 63 basis points, or just over 0.5%. In terms of a little bit of detail in that, equity returns detracted during the quarter. This is actually a little bit rare in recent times, but on the other side, the fund's exposure to listed fixed income, multi-asset and real estate did contribute positively, and that was also the case for investments in infrastructure and private credit. We'll talk a little bit about FX, or foreign currency, in a few minutes, but it's just worth noting at this point that some of the allocations to private equity in particular are in US dollars, and this had a headwind in the quarter given the deterioration in US dollar versus sterling, but I'll come back to that. In terms of longer time periods, just at the end of section 3, the fund performance remains positive, and over 3, 5 and 10-year performance, those numbers are respectively positive 6.65%, positive 10.28% and positive 7.06%, all on an annualised basis. And since inception, the fund had an annualised return of 6.31%. This is well ahead of benchmark returns and also ahead of our actuarial discount rate of 4.3%. So moving to section 4, which I'll only cover briefly. As I said, Ethan's going to do more detail on the Q1 market commentary. But big picture, the first quarter of 2025 saw stock markets across the globe effectively reverse all the gains of the previous quarter, and that was down 4.5%, mainly coming from US stocks. In terms of the UK and Europe, they both actually had positive returns in 2025, and in fact, in the UK, it was the best quarterly period since late 2022, which some of you may remember was a little bit tumultuous when Liz Truss was our Prime Minister. In terms of emerging markets, that was also positive in Q1 2025, and in terms of some of the reasons behind that were essentially falling US 10-year Treasury yield and, as I mentioned, a weaker US dollar. So the debt repayments for for emerging market countries and corporates were slightly easier to bear because of that US dollar weakness. Fixed income markets did well, although very volatile, and in the UK in particular, they benefited from stable interest rates. In the Eurozone, there was also moderating inflation, and the ECB, as you may remember, back in March, cut interest rates by 25 points, also supporting the bond market. For our fund in particular, on section 5 and page 41, within equities, as I mentioned, we posted negative returns, minus 2.4%. But that masks some fairly wide range in terms of the equity market, the equity managers that we have. So as an example, BlackRock's performance was 7%, and the Russell Active Sustainable Equity Fund was negative almost 5%. In terms of how the managers did against their benchmark, that was also mixed. Many of the fund's asset managers did deliver significant excess returns, although some were unable to outperform their benchmarks. Again, we're looking at very short periods here of a quarter. Over the past 12 months, the fund's equity exposure generated a positive return of 5.65%. Again, in the quarter, the fixed income mandates delivered positive returns, but again, with a mix of outperformance and underperformance of the respective benchmarks by the two funds. And over the past 12 months, fixed income exposure again delivered a positive return of almost 4%. Moving on to property, section 5.4, there was a positive return during the quarter and a positive return of almost 5% over the year, but performance against the index was negative over the quarter and also over the past year. Again, these are fairly short periods, and the direction of travel for real estate prices does remain a little bit unclear in the short term. However, medium to long-term prospects do remain attractive for the asset class, and we think some sectors will outperform particularly strongly. We are underweight to real estate, and to remedy this, we do intend to allocate a significant portion of capital to real estate over the coming months. And then just as a key message, again, as mentioned in point 5.6, absolute long-term performance remains positive. We do see some fluctuations over quarters and even over calendar years, but since inception, on an annualized basis, we're comfortably ahead of our actuarial investment return assumption. I did say I'd mention FX or currency exposure. and around 60% of our exposures are now non-sterling. What that means is, as I mentioned, that when the US dollar in particular is weakening, there is a headwind against our assets. So if the US dollar weakens by 3.5%, then our US dollar assets have to grow by 3.5%, even just to stay still. Now, to date, we've effectively taken a passive approach to FX risk. It's reasonable over the longer term to assume that everything comes out in the wash. You win some, you lose some. But as we've increased our exposure to non-sterling assets, and that's likely to increase given the direction of travel for private equity investments, we have been looking with our advisors if we should be doing something more actively in this space. The analysis of that is in the relatively early stages, and we're likely to implement any solution via the new WPP investment management company, which we're going to hear about shortly. In terms of asset allocation, item 6, big picture is that we're still overweight equities and underweight to real assets. I think we've talked about that for several quarters now. That is gradually, that kind of mismatch against the benchmark is gradually being corrected as we exit equity exposure in favour of our private market commitments, and that continues to be the direction of travel. And you can see the detail of our asset allocation under item 6.2 on page 45. In item 7, just really wanted to draw your attention to some numbers that I've mentioned, but you can see it in pictorial form. That shows our longer-term performance of the fund in dark green and the benchmark in light green. And again, the sort of, let's say, more important time periods towards the right-hand side, the 5 years, the 10 years, and inception to date are all ahead of the index, which of course is great to see. I think, finally, Section 8, private market commitments. The headlines there are we have committed as a fund almost £800 million to private market investments, and that's across 13 separate mandates, and around 500 million of that has been deployed to date. So that's about just over 60% of the overall capital commitments. As I think you've heard many times before, in the private equity space, it sometimes takes time for capital to be drawn down and deployed. What that typically means is that there's a sort of drag on return in the initial periods of a private market investment, which then picks up over time. We're starting to get into that phase, although we're not quite there yet. Then finally, in terms of the current quarter, so that's Q2, obviously the report focuses on Q1, but we do have some data to the end of April in section 9.2. So at the end of April, the fund assets stood at 4.384 billion. So that, again, is a fall of just over 50 million since the end of March. I can reassure members that on a continual basis, the officers and advisors of the fund do meet with investment managers, certainly quarterly, sometimes more often if we need to, and just ensure that any short-term blips are just that, and are not longer-term systemic issues with our investments. And again, I mentioned the private market investments. So, in conclusion, we did underperform in 2025 Q1. What that means is we're now slightly underperforming over 3 years as a whole. Sometimes good quarters drop off a performance record and bad quarters add on. So we've had a relatively bad quarter, although very small in the scheme of things. And Chair, to finish up, I'd recommend that members note the investment performance that's taken place during Q1 2025. Whether you want to hear from Ethan before you do that or after, I'll leave that to you.
That's very kind of you. Thank you very much. I think what we will take Ethan first, because it'll be quite interesting to get some of the colour behind the statistics that David's just spoken through. But before I do, I just want to rectify an error on my part, because I read out earlier to say that that was a report up to the 31st of December last year. It was, in fact, a report up to the 31st of March. So if we can rectify that, that'd be fine. But anyway, Ethan, no rectification is needed with you.
Thank you. And the interesting part is now we're presenting this really to talk mostly about markets since the 31st of March, because that's where all the action has been. And quite a tumultuous quarter it has been. Although I think when you look at your May performance, when that comes up, you'll probably breathe a sigh of relief in that the tumult in markets did not actually end up with particularly devastating effect on portfolios, because we have done a lot of round trips in that respect. So I think what we are seeing, and this has been pretty much a theme since the Trump administration has come into effect, has been a flooding of the zone with respect to news flow, executive orders, a big, bold strategy changes on the international stage in particular, and then followed by either reversals in some cases, but certainly market reactions. And while we as long-term investors are used to kind of long-term buy and hold positions and seeing things grow maybe or change over time, I think the really interesting characteristic of current markets is that we are seeing some real-time cause and effects and pretty clear reaction to certain policies. So which actually, this constant feedback enables us to better predict perhaps how certain policies are going to go down with markets and how that's likely to be received. Just as an example, since we last met, we had clearly Liberation Day tariffs on the part of President Trump, big, bold upheaval, essentially, of the global world order in terms of how trade had taken place. These were not well received by markets. Markets have generally, not necessarily given it the worst case scenario, in that the worst case scenario may have been a much more dramatic downturn in markets, 20, 30%. We had some pretty sharp shifts in markets in the immediate downturn. And why is this? Because it obviously instills huge uncertainty into the global market. The effect on inflation, very unclear. This has been the metric we've all been focused on for so long, as inflation. They're likely to raise prices certainly in the near term, although how exactly it will raise prices we don't know. And then so markets don't like that. And then when we started with this coined phrase around Trump not following through on tariffs, I'm almost afraid to spell it out, TACO, the markets reacted positively, because there was a sense that there was kind of the bark being worse than the bite in terms of actual tariffs. So we know that markets don't like that. The other thing we also know is that bond markets are not a fan of growing fiscal imprudence when it comes to budget deficits rising. We've already seen in the UK, we mentioned Trustonomics at the end of 22, how quickly bond investors will react when they lose confidence in a government, in their fiscal policy, in the marrying up of fiscal and monetary, and in simply that they start to treat developed markets like emerging markets in terms of company risk, country risk. And that's something we're seeing increasingly in fixed income, bonds being more volatile and simply not taking a government's word for it. For example, the big, beautiful bill in the US has a lot of spending built into it. It caused the schism between some of the most ardent followers of President Trump because they didn't like the pork, so-called, that was in that. That is a bill that will obviously add to the fiscal deficit. And whereas equity markets seem sometimes to be agnostic to a building fiscal deficit, bond markets are not. So that is another thing we're seeing directly, is that bond market volatility is quite sharply focused on with the actions of government, what they say, what they do, and on any kind of sense that there is a lack of coherence in that. So these are factors that are really trickling through the market, the bond market and the equity markets. And what are we seeing just in terms of some of the metrics? Inflation, very important for your fund, clearly. Generally, inflation is coming down around the world. However, the UK can still have the propensity for some unpleasant surprises. And most recently, the surprise in the UK was a 3.5% inflation rate. The main obsession with commentators and observers of the UK market is whether the UK will be kind of the first adopter or first mover into a stagflationary situation. Stagflation would be a combination of stagnation in the economy and inflation. Clearly, we see the inflation part still a little bit troubling there. When it comes to stagnation, the UK perhaps has been more resilient than expected, not as resilient as the US, which has been quite resilient. And even Europe has been quite resilient, given perhaps the fact that it was a market that was used to, or a set of markets used to austerity. They've kind of, in a way, hit rock bottom, and now they're making their way back. I will say that in Europe and in the UK, central banks are taking this potential for a sluggish economic growth very seriously. in that they are reacting with rate cuts. The ECB has had 8 consecutive rate cuts, and the Bank of England has cut 4 times out of 7 meetings. So clearly they are not taking anything for granted in terms of growth, and that's something that we are mindful of, which is consoling in the sense that we are investing in the UK, but equally with the pensions policy changes, we know that there is a strong governmental impetus to want more investment in the UK. So, and we've also seen the equity markets do quite well. So this has been the other positive effect. In terms of equity market developments, clearly all of this uncertainty that's percolating from the US, all of this upheaval is leading to a certain amount of erosion of the American exceptionalism claim. American exceptionalism is part of the reason we have been quite heavily exposed to US equities, not only because it made sense from a standpoint of good growth and innovation and sense of growth story, but also the compounding effect of this doing well has led to the US represent more of the indices. So we have ended up with a lot of exposure to the US dollar and US equities, although not as much as some of your peers, because of our strong exposure to the UK. So this erosion of the US exceptionalism thesis is part of the reason that the dollar has been weakening. There are some commentators would suggest it's by design. It's exactly what the Trump administration wants. I don't think that's working by design. I think what's happening is there is a loss of confidence in the US as a player on the global stage. And also, even though the economy is resilient, there is a concern about the uncertainty. So I think the investors have voted with their feet around the dollar, around the US Treasury, and that's why they're pulling back. It's not part of four-dimensional chess, whereby this weaker dollar will in fact lead to the US being an attractive trade partner. I think, if anything, the trade tariffs have suggested that trade is not something that the US is that keen on as a concept. So I'd say that that is a collateral damage to some of the policy. So we have to be mindful of that. We are clearly exposed to that. It does have that double whammy effect when our US dollar assets will weaken, will lose money, and then there's the additional value. So these are if you think about the 5 points: inflation, interest rates, equity markets, geopolitics, and other. Finally, to say geopolitics continue to be difficult, although not disastrous in terms of the flashpoints. And one thing that is interesting is that if we look at the main geopolitical flashpoints in Israel, as well as in, say, Russia, Ukraine, it doesn't seem to affect markets that much. It's receding, shocking and inhuman as it is, to the background as really background noise, and it's not affecting market movements. So that is just a factor. So we may be upset by geopolitics, but it doesn't seem to actually affect markets. So that's one thing. And then just finally, where does this place just general macro things? We're still seeing flows out of renewable energy and other funds like that. ESG or anything tainted with that has come out of favour, definitely in the US. I'd say it's actually firmly still has resolve behind it here in the UK, and renewable energy, a lot of exposure to that. This will not be, I think, a global phenomenon. Other areas such as, it's clearly the high discount rate is clearly making pension funds healthier the world over. That's a nice, again, collateral effect of having higher rates. And as we look to this quarter emerging, clearly with these tariff stays or the 90-day delays are going to be coming up for expiry, we'll clearly see some more big bang developments there, negotiations, promises made, promises kept, etc. Let's see how that works out, but I think we now know that markets do not like uncertainty in this respect, and that the President is still focused on markets. So we may see less disruption, perhaps, as a normalisation kicks in. And then the bond markets will clearly be looking at them carefully to see if they provide stability, because with them as they are, it is still creating a bit of havoc for fixed income investors, and it's making things quite challenging. So I think I'll leave it there, and happy to take questions.
That's a rather diplomatic finish. I've got some questions and some comments, but I'm happy to take other members first. Again, I've got David in the room, then I'll come to the screen.
Thank you. Just a couple of not random but mixed points. Firstly, you've given some indication, even, but do we have a clearer picture about how we might be compared with other peer funds around performance? Because that's sometimes helpful to get an idea about benchmarks. First one. The second one was, I think, David, you mentioned about sort of how to the fact we got sort of a significant amount, 46% was in US dollars, and maybe how that might be managed more actively. So just perhaps any thought on that. And then finally, one of the things we've touched on before has been sort of how the kind of big tech companies have been performing, and how has that been impacted by this volatility in the US, because that tends to be kind of high grade assets as well. So those very random, Chair, but they go.
We've had far more random in the past. I'll take David first, if you can answer the specific questions, then maybe come on to Ethan to catch up on the others.
Yeah, so I'll defer the point on peer group performance against other pension funds to Alex, because I think you probably have more insight on that. In terms of your the FX point, as I mentioned during the presentation, there's a reasonable school of thought that it all comes out in the wash, just kind of leave it. It's certainly a reasonably famous quote that if you want to lose money, try and predict currency markets. So, and that's something we would have to do, because of the, we're looking in the rearview mirror. The US dollar has depreciated 3.5% over the first quarter. Yes, we can look at economic indicators and direction of travel, etc., but predicting what it's going to do in the future can be tricky. But in terms of how we want to look at that, is whether we can be active, whether we can actually say, here's a specific amount we want to leave unhedged, here's a specific amount because we could hedge everything, right? We can just take the risk away. That's another reasonable way to do things, although hedging obviously costs.
Yeah, I don't mean to interrupt you, but I've been banging on about the topic of FX for years now, and as Ian knows, we've been dealing with this at Bedfordshire, where I'm also investment independent advisor. And one of the reasons was because Bedfordshire is one of the 5 lowest funded LGPS in the whole system, so you really need to claw after every, basis point of return you can. I think the whole world of FX hedging has moved on quite a ways, and we actually decided in 2024 to look into being more actively managing this, but not in the ways you were suggesting, like taking a view, the pension committee, of whether sterling or dollar is going to be strong. There are actually a lot of strategies that are using a lot of sophisticated sort of models and long-term trends and a bunch of factors, very much the way some of these equity strategies do, to come up with rates of degrees of hedging that you might want to undertake versus the different currencies. And it's not in any way static. It's much more dynamic, based on long, short-term, fundamental, technical, all sorts of factors and things like that. And with a lot of doing, we did actually run the procurement process and finally implement this at Bedfordshire, and went live in the beginning of April, just right around Liberation Day. It took a lot of doing. It's something I've mentioned to Alex in the past. I do think this is, when I write these sections about FX hedging and things like that, and I think this is something a bit more intelligent that we might think about. Remember also, while people can take a view that FX over 10, 20 years, you could say it's a zero-sum game. I'm not sure I believe that. We have 3-year annual valuation things, and if FX is a swing factor and it changes your value of your assets because all your liabilities are in one currency, it's like running a bank with a multi-currency portfolio and funding it all in sterling. Nobody would do that. So anyway, I think just this should be a topic we might consider more seriously, and also I'm not sure it's an asset thing. I think it's a liability risk management thing, which I think still resides with the administering authorities. Anyway, end of prepared remarks.
Thank you very much for that. David, have you finished what you were about to say, what you were saying?
On FX, yes, but I think there was one more question, which I think was around the Magnificent Seven, or Batman, or whatever they're called these days. I think the specific question is what's the impact on some of the stuff that Ethan was talking about in terms of that, so I'll certainly pass over to Ethan. But in terms of those particular stocks, as you know, I can't remember off the top of my head, but in 2024 they contributed a vast amount to the percentage increase in the US stock market. I think for the first quarter of this year, the reverse could almost be said to be true. So they are kind of, you know, leading from the front or losing from the front. That's just the nature of these stocks. But Ethan, do you want to say anything further?
Yes, I think Northern Trust has quite a lot of mention of that in their market overview on page, I can't say 72, but just because I mentioned it, not with respect to our portfolio. Very interesting to see them as like a barometer of this AI, as a shining light. That seems to be one of the factors that is really offsetting some of this concern around the US and some of the American exceptionalism fallout, because AI still is the centre of innovation, and certainly, I'd say, see a sizable moat to take a Warren Buffettism there in terms of just these large Mag 7 with their significant cash piles, their ability to invest in AI and really just see genuine revenues already flowing, so it's not kind of speculative investment. So they have done well, that they did very well. I think it says here in Northern Trust 60% out of the 20% of global equities last year. They also fell the most severely in the aftermath of that. And then that's when we saw the non-US stocks really rally and some of the more defensive stocks rally. It was a kind of reversal of what we'd seen. And then just in the last few weeks, post the kind of the TACO idea that the tariffs meant nothing and that we do have uncertainty, but with these companies we're still going to be in a pole position to dominate. It actually started that they resolved their underperformance, so they've kind of gone right back to performing in line with the other stocks now. So I'd say there's still a factor. Obviously, we need to make sure we're not overly concentrated there as we speak with the managers and they're active. But I'd say the final thing is because of this distortion that they've caused, it's been a difficult climate for active management because it's been really hard to predict how long they would stay in that pole position.
Thank you very much. So Alex, do you want to ask the question about the comparison?
Yeah, thanks very much. And Councillor, to your question, which was about how the fund, I think, if I understood correctly, how the fund is performing relative to the peer group. There is a pension research analytics called PERC, which we subscribe to, and what they do is they assess the performance of a big proportion of the LGPS schemes. And actually, just last week, I've got it in front of me, but as of the 31st of March 25, so the period that we're referring to today, 47 of the circa 86 funds have been analysed, so that's about 225 billion of the total assets. What that's suggesting is that the latest year performance on an average basis is about 3.5%, 3.4%. And just a quick comparison with the fund, our 1 year performance to March was about just over 5%. Over 3 years, that was 2.8 per annum versus a sort of 5.6 per annum for the fund. So there's actually quite a lot of analysis here that once the full report is prepared, we'd be happy to circulate for information. But I think the indication suggests that the fund is certainly performing in line with its peer group, if not over and above, which is pleasing.
Well, it sounds more like over and above than being in the pack. I mean, so actually that's very good. If you look at some of the decisions we've taken over the last 3 years, I wish I could say I had a crystal ball that I knew the last 6 months was coming, but we've actually put ourselves in quite a resilient and in quite a good position. So well done, everyone, on that one. I've got some questions and some points, but I'm mindful. John, Stuart, any questions? Can you put your microphone on, Stuart, please? Was that you indicating? If so, no. You need to put your mic on. Okay. Maybe Stuart, if you have a question, I'll take. You can type it in the Teams. But also, if you don't have a question, just type no, and we can move on. But I'll.
No, sorry.
Yeah.
So hello there, Nathan. Sorry about that. No, I can't hear you, mate. Sorry, I haven't got my technical difficulties sorted out, so but I haven't got a question.
All right,
thank you.
Well, I'll tell you what I'll do in the future then, for the rest of the meeting, instead of wait. If there is something you want to say, put your hand, put the little yellow hand up, and I'll see that and I'll call you instead of going back and forth. Right, yes, I have some questions, and there's on a general point, I think of the main bit of that report, paragraph 6.1 is encouraging. If we are now actually finally shifting some of the ratio in the strategic asset allocation to where we want it to be, it can probably still be done a bit quicker, but at least it's moving in the right direction. I've got a specific point on the Northern Trust report, which we hardly ever come back to, and it's it's like an information point on page 74. What did I want to say? And there's an issue there when they're talking about the exposure of DB pensions in the UK, and it's just a question, do we know whether their definition of DB includes the LGPS for the purposes of the statistics they're quoting, because obviously we are a DB pension, or whether they would be treating us separately? Or is that something we're going to have to go back and ask them? Fine, okay.
Is this the point about surplus?
Yeah.
I'm not sure that surplus is a concept within the LGPS, so my guess would be this
is just normal DB.
This is the closed,
normal DB.
Yeah, closed DB.
Well, I was asking questions whether they were actually taking those funds that were over 100% funded. You could take that as a definition of being in surplus. This is where I get schooled properly now.
Well, you could, but it's less clear if it's open.
That's okay.
But I bet it's probably worth clarifying.
In which case, somebody to my right on the table, could you ensure that gets clarified, please? And then the other point just comes back to the general stuff about America. I think, obviously, in the main report on paragraph 3.2, I think it did make me start thinking here, there's a question about, with the caveat that we've only had 6 months of this, is there a suggestion that, for example, US stocks, regardless of their asset allocation, are being affected by the volatility over there? Or is it the case that some of those stocks that rhetorically the current administration has decided to target as being stocks they don't like or trust, i.e. ESG stocks, have they performed disproportionately badly in terms of the volatility? But there's also another angle. Is there any suggestion that ESG stocks globally have been affected by the rhetoric coming out of the White House in the last 6 months?
Yes, well, just to start with the US stocks, there are a couple of things. Technically, there are fewer non-US buyers of US stocks today. However, there is a lot of money washing around that system still. A lot of retail savers, they've generally been buying in, whereas institutions have been buying out. So that has actually not been as detrimental as, but if we look at the performance of US stocks as a whole versus non-US stocks have outperformed. So there's clearly some funds flow going, and I think that's all stocks. So all stocks are going to be somewhat less favourable, and where will be even less favourable again, mid-cap and small-cap stocks, I think, are, despite the fact that they shouldn't be exposed to global trade, they are not the stocks of pricing power. Everyone imports something from China as a cost, as a kind of a component of what's made, and I think those stocks are looking a lot less attractive than the big cash-rich Mag 7 large cap that have ways of either pushing pricing power or absorbing, eating the tariffs, as Trump would exhort that they do. So I'd say, yes, it's all US stocks. In terms of non-ESG stocks, definitely they are particularly penalised. But we're seeing a lot of volatility in stocks. For example, at the Big Beautiful Bill, when that came out, solar stocks completely tanked in the US because there was a suggestion of pulling away subsidies for solar panel installations. So that would completely upend the business model of solar installation in the US. And similarly, in EV stock subsidies, that would also clearly, Elon Musk didn't like that particular provision of the bill. So these are all chipping away at the values of stocks there. And similarly, that does have global contagion because many of the business models just depend on a certain amount of global scale at times. It's not to the same degree that we've seen, but we've seen already Ørsted and other stocks that are European stocks that are leveraged to the renewable theme. They definitely have struggled. So it is, it shouldn't be the case that there's that level of contagion, but yet there is an element of contagion. And does this mean that they're at rock bottom now and present interesting opportunities? Very well, because just as there is a chickening out, so to speak, on the tariffs, there could also be a rollback of some of this anti-ESG or anti-renewable energy, because what we do know from data centres is that there is an insatiable demand for all kinds of energy, fossil fuel and non-fossil fuel source. So that could well be overdone in a sense that point. And we also know that states such as Texas and Florida, which will be politically against ESG, happen to be the states where there's quite a lot of investment in solar farms, etc., because they are obviously well positioned for that. So I'd say, and even BlackRock has joined the buy list again for Texas institutions. So a little bit of lip service in their case to pulling away from voluntary organizations like Net Zero Alliance, and they're back on the favoured list. So it doesn't take much to really get around some of these, I suppose, politicking around this issue.
And that was one of the points I was going to raise, actually. It's going to be quite interesting, I think, looking over the next 18 months at least, is actually what the distance is between rhetoric and practice when it comes to actually what the market is, how it's performing, what it's looking at. Because there is this, the irony, shall we put it, that when you have Elon Musk being sort of leading the charge for reform in Washington, as essentially cannibalising his consumer base at Tesla, and it's interesting how that's having a fundamental sort of financial effect on his bottom line, and straying into politics, but then realising actually how then certain activities are going to change, because essentially if the bottom's falling out of his major companies, he'll have to shift his rhetoric slightly. Betty, if that's specifically to do with what we've just been talking about, you can come in now. Otherwise, if it is, you can come in, then I'll take John after Betty's spoken.
Yeah, I just want to say briefly that I think there is a lot of growing gulf between what's stated and what's really going on. And one of the small companies in our Invesco Capital Partners thing is a small energy company called Frontier Energy. Makes you think of an oil tar sands company. It's actually helping do the Internet of Things, basically decarbonize industries in the U.S. But they're masquerading as though they're oil companies. So I think, you got to really look up. It's really a decarbonization strategy masquerading as though they're still full tilt fossil fuels.
John.
I'd just like to say that the opposite of the ESG shares, for example, that everyone's divesting themselves of the defence sector industry shares, they seem to be doing extremely well and bucking the trend completely. I just find it strange that people are divesting themselves of defence shares at a time when they're absolutely going through the roof in most cases.
Well, I don't disagree, and just to point out that's not the position we're in. And obviously we've had this discussion here previously, that at a time of geopolitical uncertainty, I think I would not want to be leading any charge away from those kinds of investments. So nothing to worry about here, although I'm sure that will get me a program online. The other point I wanted to make, though, going forward is actually is the extent to which we need to work out again over an 18-month period whether we need to start thinking about what a wider sort of hedging strategy would look like for US investments, whatever the type. Because I'm conscious of what you're saying about the FX markets. I mean, if that looks like a long-lasting issue, we need to take a view to what extent are we going to still be playing in that market, to the extent we are, and whether we need to be placing the currency elsewhere. But then it's also an interesting thing, isn't it? I think we need to come to a point where we take a view whether continued volatility in the US, if that is indeed where we're going to be, will that act in a sort of pump priming manner to accelerate some of the shift in the strategic asset allocation when we're thinking about investing in domestic stocks, and whether unwittingly sort of US central government policies might be helping UK government policies eventually. Ethan.
I'll turn to Betty on the currency hedging and whether this is the time. I mean, we've already seen about an 8 or 9% fall in the US dollar versus sterling year to date. So we're still in a way that's been already quite a bit taken out of that already. I'd say it does, though, because between the big, beautiful bill and what it's including, and tax poison pills, as they've been deemed, whether that will come into legislation or not, there is still quite a bit of uncertainty circulating now around US investments and the backdrop to that. And we know that it's not just in private markets. CEO uncertainty is very high. And that will probably lead to less investment, maybe kicking the can down the road in terms of other investments. And I would suggest in Europe, we mentioned defence stocks, just one example of a stock that rallied and soared on the back of commitment to reinvest in defence and unwind some of these perhaps deficits that have been in place for a while. So I'd say Europe is actually, having been oversold and overlooked for so long, is probably at the margin quite interesting for some of these investments. And equally, as trading alliances are recast, there could well be new supply chains that take root, and with less dependency on the US. So that, I think, as we're allocating, we should be in dialogue with our private equity, our managers that are engaged in this, as to whether they're seeing more work being done at the margin in Europe relative to the US. So that may well fall out of the asset allocation where we invest globally, that they don't allocate all there.
Thank you very much. Last intervention for Betty.
Yeah, I want to, for the record, say that we had already highlighted this issue when we last looked at SAA, I think in 2023. And I think this can boil down into being how much exposure you have to sort of market cap weighted indices, whether in a lot, we have a lot of it in the low carbon tracker, which we have with BlackRock, which is the main source of some of this volatility. And then some of the, active managers within WPP, within the Russell strategy, may also have some exposure to these. I don't actually know, have to look through to what it is. But having a broad sort of market weight global index, which gets dominated by the US and then by a few stocks, is something that I think we should pick up again. I realize it's been a very, very busy period. Alex and I have from time to time spoken about it. I'm not sure within among the WPP funds it's that widely appreciated. There was some work on another product which didn't do anything to change the exposure to these market cap weighted things, whereas I think that is a risk that we should focus on and look at other strategies. Don't just give you the pure market cap weight.
I agree. Okay, in which case then, moving on, I'd like to point members to, where is it, the recommendation on, the recommendation is at paragraph 11.1 on page 48. It is recommended that members note the investment performance that has taken place during the first quarter of 2025. Everyone happy to accept that? Excellent. Moving on then, agenda item number 7. For the first time today, I'd like to hand over to Alex for the Wales Pension Partnership WPP update that starts on page 81.
Thank you, Chair. Let's say good morning, everybody. This is the first of 2 Wales Pension Partnership or Welsh PS pooling items on the agenda, but I'm going to try my best to sort of keep them separate so far as possible. Hopefully members are familiar with the structure of this report by now. It is very much our standard quarterly update on the business of the Wales Pension Partnership. As ever, there is a bit of a reporting lag in terms of the meeting minutes from the most recent joint committee. Those are in the pack today relating to the meeting that was held on the 12th of March. There has been, and there was a meeting last week on the 4th of June, which was essentially an extraordinary meeting to recommend and to request some further approvals from the Joint Committee in order to continue progress relating to Project Snowdon, which we'll talk much more about. So for the purpose of this report today, it's generally a full information report, but there is a recommendation to approve the WPP's business plan, which is for the period 25 to 28. Before we get there, though, let me just run through a couple of notable points. I think page 82, as ever, we refer to or signpost members to the Carmarthenshire County Council website, where you can access the agenda items and the minutes from all of the Joint Governance Committee meetings. Those are also webcasts, so the recordings are available for you to watch back should you wish. Obviously, Carmarthenshire County Council are the host authority of the pool. In terms of the operator update, as ever, there's quite a detailed pack that Waystone provide and present to the Joint Committee. That is included largely for information, I suppose. Given that there's so much more on this agenda today, I think I'll just take as read that the appendix is there for your information. The bottom half of page 82 summarises the exposure that the Greater Gwent Pension Fund has to the various Wales Pension Partnership sub-funds available. As you can see in paragraph 5.3, just shy of 3.4 billion of the funds, so circa 4.4 billion, are now invested via the Wales Pension Partnership. That's just under 76% of total AUM, so we are continuing to make our progress towards having all of the assets pooled. As was discussed in the quarterly investment report, the big area of progress that the fund can make is around its private markets allocations. Those are very much ramping up now, as we could see. There was also reference to real estate, which is another area that of allocation that the fund will make into Wales Pension Partnership developed funds and strategies. So we would expect to continue to see that progress over the near term. I think at this stage, I'm just referring now to page 83, which is under paragraph 6, is the WPP business plan. I'll present some of the high-level points here and then refer to the appendix specifically, if that's okay. So, as ever, WPP annually prepares its business plan. You can see there that in essence, that is explaining and setting out the background, the governance structure of the pool. It also sets out the priorities and objectives, the policies that it maintains, the training that it provides to members, and crucially it also outlines the budget for its activities, which is borne by the underlying 8 Welsh pension funds. It also summarises some of the investments, or all of the investment products that are now available. The reason that, so this is agreed annually, typically in March, and it actually was approved by the Joint Committee at its meeting in March down in Swansea. Since then, obviously, an awful lot going on with the local government reforms, as the government have announced. And as a result, the business plan was presented to the Joint Committee last week with an update around its budget, primarily around the costs for the enabling costs associated with the investment management company build. So we can talk a little bit about that in a second. But just as a procedural point, I guess, the purpose of bringing that to the Pensions Committee today is that per the inter-authority agreement that binds the partnership, this is one of those reserved matters. So ultimately, Joint Governance Committee approved the document. It then goes to each of the 8 pension committees for their approval before that can be published and obviously be put into operation. There is an extension, and this is where I'm slightly straying into the next item, that as a result of the significance of the reforms underway per the LGPS pooling regime, the business plan will also find its way to Torfaen County Council as the administering authority in July, but we'll cover that in the next item. So I think at that point I may just turn to the business plan itself, and there's just a couple of comments I wanted to make. So the business plan starts on page 115. As I mentioned, there are a number of sections of this document that are there for information. Some of it is quite sort of static in terms of the governance and the way in which the partnership operates, the risk management approach, etc. If I could just ask you to turn to page 124. So pages 124 into 125. This outlines the work plan for the year ahead, or for the 3 years, I should say, given that the plan covers that 3-year period. There are a lot of items on here that I'm sure members will be familiar with and would be expecting to see, especially around things like around governance and investment oversight. But in particular, there are a couple of notable points. So this year we have introduced the delivery of Project Snowdon. Project Snowdon is effectively a task and finish group. It's a project group that has been established in response to the government's consultation and subsequent direction for Wales to develop and build its own investment management company. So that is a subset. It's largely a reflection of what already exists. It's representation of the elected members of each of the 8 pension funds and the senior officers, both the Section 151 officers and the senior practitioners that administer the scheme day to day. So again, that sort of will have more detail into the next item. But Project Snowdon, we expect to be delivered within the sort of next 12 months. That the government have set that time frame of 31st of March 26 to have the new phase of pooling operational. There may well be a quarter or perhaps 6 months whereby there is still some transition work underway, but by that point we would expect the company to be operational. And I think that really flows because there's reference to budget at the bottom of page 125. Clearly an important part of the business plan is to establish the annual running costs that we expect. That has increased as a result of what we just referred to in Project Snowdon. So page 127, this does give you a snapshot of both the outturn from 24-25, obviously the prior year. It then outlines the proposed spend from 25-26 through to 27-28. You'll notice that actually that there's not an awful lot of change in sort of anything other than the Project Snowdon line. The costs at the bottom half of this table really are the investment management costs, hence the significance of them. And obviously this is on behalf of all 8 pension funds, so circa 25 billion of assets. The top half is much more the oversight and administration, I would say, of the partnership. So you've got the host authority, which is Carmarthenshire County Council. That's predominantly staff costs for officers from Carmarthenshire that actually administers the partnership. You've got our external advisor costs, which are oversight advisor Heinz Robertson. You've got our legal advisors, amongst others. And then, of course, you've got Project Snowdon, which in essence is is broken out for the transparency, but this now identifies the additional costs that we perhaps estimate over and above what we would say is business as usual to accommodate this project. So in 24-25, just shy of £500,000 was spent, and that was largely consultancy advice supporting the extensive work that has been put in to date around responding to consultation, preparing the business case, all of which feature in the next item. For 25-26, that is largely an extension of that cost, so we would expect that the support that is required to build the investment management company to come largely from external advisors, although, as we've talked about previously, there is an awful lot of officer time being consumed by ensuring that this is done properly and obviously to minimise costs. So within the business plan, there is a budget allocated for costs that the partnership will incur between sort of 1st of April 2025 through to 31st of March 26, by which point a budget will be established for the company to operate and to manage those resources as it sees fit. I think, Chair, that is perhaps all I would say in terms of comments on this paper. Obviously, the recommendation is to seek approval of the business plan, but I'm happy to take any questions or any comments.
Thank you, Alex. Actually, what I'm going to suggest is that we park any decision on this item. I think it would make much more sense to go over to ask David to talk through item number 8, to actually talk through the consultation and the proposals that have come out of the WPP in response to the government initiative. So actually the members have got a better understanding of what Project Snowdon is and actually what we're looking to create over the next, crikey, it's only the next 9 or 10 months as the months are going by. And then actually once David has gone through, like I said, item number 8, and we've answered questions about that, then we'll come back and take a decision about the request to alter the budget for the current year of the WPP business plan. So if you hold your horses, everyone, with your questions, I'd appreciate it. So over then, ask David to present agenda item number 8, which is the LGPS Fit for the Future WPP submission to government, which starts on page 133.
Thank you, Chair. Yeah, and I'll try not to overlap too much with the previous item. I think Alex did a good job of not straying too far into this one. Hopefully we haven't missed anything between us. Just to start, because dates and timing and lag might complicate this more than it needs to be, but the purpose of this report is to seek this Pension Committee's support for the proposed recommendations that are contained within this report and to endorse it to Torvine County Borough Council for formal approval at the Council's next meeting on the July 22nd. So hopefully that's not too convoluted and clear, but that's what we're looking for today. So in terms of background, and hopefully this isn't at risk of repeating some of the stuff that Alex just said, and obviously members have heard much of this before, but I think for context it's important just to have a little history. So back in November 24, the government did launch a consultation. It was called Fit for the Future, and it included a number of proposals which the government said would put the LGPS on a clearer, firmer trajectory to scale and consolidation, as well as measures to improve scheme governance and investment capabilities. So all very laudable aims. That consultation closed on the 16th of January this year, and we did submit in advance of that deadline, in consultation with our chair of the Pension Committee and colleagues across the Wales Pension Partnership, we submitted a response to that consultation in good time. After this, one of the as part of the consultation, one of the requests of government was that all pools in England and Wales, so in our case WPP, prepare a business case submission by the 1st of March, setting out specifically how pooling can be enhanced. And remember, this is all building on existing pooling arrangements that have been in place for many years. But they wanted us to focus on benefits of scale, resilience, value for money, and our ability to complete the project by the proposed deadline, which Alex mentioned is 31st of March 2026, and is fast approaching. So the reason for this report is that Project Snowdon, which is how we have termed the project to produce that business case, and then everything ensuing from that was created back at the start of this year. I think Alex mentioned it comprises Section 151 officers from the various authorities. There are also other officer representatives and representatives from the various advisors and service providers to WPP. The business case was approved by the WPP Joint Governance Committee in March of this year and was submitted to government on the 12th of March. And it set out our business case to retain a standalone investment pool for Wales and proceed with building the additional proposed new government requirements I've talked about in terms of the pool operating model. And again, just to emphasise, this is building on what we've done today in Wales and within the WPP. So a key part of the business case was to establish a standalone Financial Conduct Authority, or FCA, authorised investment management company, and to move all WPP assets into this investment management company in line with those timescales that I have mentioned. But we also, in the business case submission, talked about the how we evaluated the business plan against the government's criteria. So those were benefits of scale, resilience, value for money, and as I mentioned, ability to get it done in time. For those that don't know, in April this year, the government did approve that business case, and they requested that we proceed to implement the plans in that business case and also to keep them appraised of progress. So the project group, so Project Snowdon, has drafted a report to be taken to all 8 constituent authorities to attain the necessary approvals to proceed with the delivery of that business case proposal. That is attached within Appendix 1. I don't propose to actually refer to it at the moment, Chair, but obviously I can take questions on that. This is where the timing becomes a little tricky. The JGC, at the time of writing this report, were going to be asked on the 4th of June to consider and support the report. I'm pleased to say that as the 4th of June has passed and as the JGC meeting has passed, that support has now been provided. So the JGC has provided support to the report. And the intention is that, subject to council approval in July, a final report will return to this committee, so this pension committee, to agree the go-live approvals at the meeting of this committee in December 2025. And of course, we will keep the committee updated on progress throughout the remainder of this year and up to the end of March. So, as I say, the ask is that we would like this committee to endorse the submission of this report to the County Council, the County Borough Council, for approval in July, on its meeting in July the 22nd. I'll stop there, Chair.
Okay, that's very helpful. I might have used my position as chair in a minute just to talk through some of this about the decisions we've taken and what it means, and actually why this is a very important decision. This is a very important decision. It seems like once a year at the moment we come here and say, this is going to be the most important decision you're going to make this term. This is probably the third most important decision we've taken. This is the fourth year of being the chair. I think just to underline some of the points that David has made, as we said, the incoming government last year took a very strong stance on pensions and investments in general, and the need actually to sort of try to revivify the UK economy to see what it can do about creating a better investment infrastructure in the country, but also to take a much more of a forensic view as to what government policy might be changed in an attempt to try and kickstart greater investment into UK domestic assets and also for greater investment in big ticket projects. And this is the main reason why the pension reforms have come through. The government, as both Alex and David have said, have responded to the various consultation responses they've received, and in fact the pensions bill was published, I think it was last Thursday, if that's the 5th of June, which is a crucial thing to point out, because that now means this is going to happen. There have been conversations and a certain scepticism, understandable scepticism, in some quarters and from some funds, I think, who felt that they didn't want to be setting up new systems, new institutions, and crucially spending more money in the short term until there was certainty coming from central government that this initiative would actually come to pass. But now that that legislation is there, hopefully it's calmed the horses down a little bit. As officers have said, the key issue here is for the pooling platforms as currently existing in the UK to basically sort of become souped-up versions of themselves, and for us all to be working towards this position of having 100% of our investments managed professionally by the pools, instead of there still being investments managed separately by the 86 or 87, depending which paper you read, underlying LGPS authorities in the country. Crucially, and I think we just want to stress this because this is one of the reasons why we are being asked to make greater investments in the next couple of years. The Wales Pension Partnership, alongside two other pools, have further hoops to jump through because of the legal standing and the nature of the current pooling arrangements compared to some of the others in England. In 2015, when the pooling arrangements were brought into play, there were two options. There were basically two ways in which local authorities went. Most of the 5 of the pools, all of whom in England, took the view that at that point they would set up fully FCA accredited private institutions, i.e. private companies, to act as the pooling platforms for the relevant funds. Wales and 2 others, Access, which is now being wound up, and the Northern Pool, chose not to create FCA accredited, fully city-compliant organisations at that first step. They chose to create, we have definitely chosen to create, what is a corporate joint committee, a rather stately body that is a joint committee of the 8 underlying authorities and those 8 councils. And in Wales, we operate in what has been called, what we refer to as a rented model, which means that the WPP itself is quite a lean organisation and that we do not employ any investment managers or provide that investment management expertise in-house. So we actually have 2 hoops to jump through here. One is to provide a pathway to a pooling arrangement that is more compliant with the government's long-term views. But secondly, we also have to create this new financial institution almost from scratch. Now, it's not, actually that's probably the wrong way of putting it, we are evolving many of the current practices coming out of the WPP into a company, but the crucial challenge facing us ahead of the 31st of April next year is we have to create a company that is fully compliant with the Financial Conduct Authority and start creating an organisation that, over the course of the next 2 or 3 years, will be capable and able to be providing that investment management expertise from that organisation instead of paying managers and consultants to provide that expertise for us. Obviously, so the idea there is actually we should hopefully be saving money in the medium term as some of those functions are migrated into the organisation. So the creation of this new investment management company needs to be done properly. So I think actually, although it is always an awkward subject matter when we're looking to be increasing costs in the short term, I and some of the other chairs very strongly believe that actually, as this is the direction of travel and we need to set up a company, we need actually to be investing in the short term to ensure that this is the best possible company we can create, to ensure that we create an institution that is both robust and has credibility in the market. So let us not forget, within the next 5 or 10 years, we are American volatility notwithstanding, referring back to the previous item, in the next 5 or 10 years, we're on a flight path to actually there being £30 billion worth of capital available within Wales that belongs to the 8 funds. So actually, if we're setting up an institution that will be managing that amount of money, we need to ensure it's done properly. That is crucially the main reason why we've taken the decision to alter the business plan to allow for that investment in the short term. Crucially, we need to be employing the best people we can get to come in to be the Chief Executive Officer, the Chief Risk Officer, the Chief Finance and Information Officers. That's the main reason to overcome in short. in the short term. I think, but other things to stress is it does provide, like I said, an opportunity to create what could be a market-leading financial institution in Wales. Once this is established, it will be by far the biggest player within Wales in terms of assets under management and the ability to actually deploy that capital to invest both across the UK and globally. I think, again, if you're looking at the medium-term strategy for this organisation, if we set it up correctly, there is a possibility for us to actually become much more commercially minded and to be operating, or to be offering rather, potential investment management services to other pension companies or to other institutions within Wales who might want to come to us to ask for us to manage their investments on their behalf. I think crucially that's something we've been pushing, because as we'll be coming to in the items in the exempt, or the item in the exempt part of the meeting, anything we can do to increase income and bring money into the new WPP is a good thing, because the idea here is we need to be, if we can continue to offset employer costs, that would be a very good thing to actually bring down the cost of the contribution rate to the host authorities. Lastly, I think also, as you've said before, setting up this institution also gives greater added impetus to those of us who've been pushing for the impact focus and actually trying to work out how we can invest in some of these UK domestic allocations, and crucially for us to see what we can do whilst maintaining our adherence to the fiduciary responsibility. Never let anyone never forget that, to actually see what we can do to actually put some investment back into, much needed investment back into some Welsh infrastructural and other impact related opportunities. That's enough from me. So members, any questions or queries? David.
Thank you, Chair. Thank you very much for the explanations, and obviously this is a process, and we've had some quite lengthy discussion on this in the past, and essentially I think we all agreed that sort of the taking forward a business case for WPP to remain as a Wales entity was the right way to go. So I think that was a decision that's already been made and confirmed, so that's no problem there. I suppose just a couple of points really. First is that I presume that we may have some, I suppose where I'm slightly anxious is when I'm looking at budget on page 127 and I'm seeing TBC under 26-27 and under 27-28. I would have thought that we may have some opportunity to get some idea of what those actual costs have been for those 5 pools that did set up an FCA accredited body. Is there some scope for sort of some level of benchmark in terms of what that outlay is likely to be on an annual basis? That's my first point. Second thing then is, it's a minor point, but obviously as a result of these 2 papers, we've had 2 copies of the business plan, one on page 215 and one on page 115. So perhaps we can cull papers to prevent that kind of mass, because there's a lot of stuff that tends to come through. The thing that I'm slightly more, also slightly I'm not sure about, is what is then the revised role for us as a pension committee with this new body, vis-a-vis the other pension committees, and also then what is the role of the pension board? You have a Wales pension board that takes a general oversight, etc. Now, it may not be possible to answer all those questions, but I think they're reasonable considerations and concerns for those of us on the committee.
Very well put. Alex, David, would you like to answer either of those? Alex, why don't you do it?
Okay, thanks, Councillor. So I'll definitely kick off, but please, colleagues, jump in. So I think, taking your questions in turn, the first was very much about budget and benchmarking against the pools that already exist. We're very mindful of that, first and foremost. As I sort of emphasised in my presentation, the business plan cost is obviously an important consideration. As I think David alluded to, we would expect over time this investment to generate a payback period, because clearly the economies of scale and further economies should add value over the long term. At this stage, we are developing an organisation from the ground up with a lot of uncertainty, and I think what we are comfortable with is identifying a budget for the build and enabling works, which is, as I described, is basically from April this year through to March next year. The business case itself, which is in the appendix, I realise that references things like salary costs, which are likely to be significant. Those are very much based on industry and sort of city-led benchmarking. So we have an indication of what this might cost, but until the organisation is created, it's very difficult to even establish that budget at this stage. So that's something that's a work in progress. We're working on it actively as we progress through this process. And what I would expect, as David has alluded to, there will be a go-live decision paper that will find its way back to this committee, most likely in December. So at that stage, I would expect us to be able to disclose what future budget impact will look like. And obviously that will be continue to be a cost-sharing arrangement with our colleagues across the other 7 funds. On the benchmarking point, we have engaged, and there is some open transparency with a number of the LGPS pools. As you can imagine, it's quite sensitive at the moment with the government's outcome and the fact that 2 are having to look at alternative options. So we're mindful of how reliable and how sort of we are able to access that sort of information and what we really can do with it. So we're looking at what we can build into a sensible and robust budget, and as I say, that will find its way back through to the committee later this year. The point on the business plan duplicate, we were very conscious of that. I see Lewis looked at me as we were talking about it because we had this debate last week. It's a bit of a tricky one. So the business plan sits in the WPP, so item 7, specifically for approval. It then exists in item 8 because we eventually will add that to the council's papers and appendices for noting and for approval. So it sits in both. Because the 2 reports have slightly different purposes, but we appreciate that the length of the pack is challenging even with a week's notice. So apologies for that. The final one, and I think I'll maybe try and tackle both of these together. You asked about the continued role of the Pensions Committee and the oversight of the partnership and whether there would be some form of board. So firstly, the role of the Pensions Committee in its purest sense will not change. So what the government have been very clear about, and the consultation response followed a couple of weeks ago, is that the Pensions Committee will still be charged with overseeing obviously the administration of the scheme, the good governance, and in its fiduciary duty, setting its investment strategy. So that's its beliefs, its objectives, and that's obviously balanced with how the scheme is funded, which we'll have an item on later in the agenda. Beyond that, there are some changes, so things like setting the strategic allocation, how much you might allocate to equities versus bonds. That is a little bit more of a grey area than perhaps historically. The government would like to see that the role of the local government pool as opposed to the funds and the administering authorities. But I think there is some acceptance that naturally the sort of setting an investment strategy and thinking about how you allocate those assets is sort of, you can stray the boundaries. So I think there is still a sensible conversation to be had about how that will work in practice. But fundamentally, the committee will still set its own strategy. It will still establish its own beliefs and objectives. And crucially, it will also continue to oversee the work of the partnership and the pool in its new regime, as it has done for the last 6 or 7 years. That kind of ties into the oversight of the company itself. So, and as David reminds me frequently, what you would expect typically in a shareholder arrangement, because the establishment of this investment management company will mean that the councils, the administering authorities, will become the shareholders and the partners in its not-for-profit, wholly owned company. And as shareholders, you will be able to have a certain level of influence, but certainly oversight of that company and how it operates. And that will be clearly defined within a shareholder agreement. Now, we have an inter-authority agreement which binds the existing joint committee, and a number of certainly the culture of that working and the collaboration of that working arrangement we would expect to find its way into the shareholder agreement. So there will be legal documents that will bind the company to the shareholders, but also what we will expect to be established is various oversight forums. So that will be at officer level, but also at elected member level. And some of the detail is still to be worked through, but we would expect that there will be forums whereby elected members of pension committees will have appropriate and suitable oversight of the company. And things like the company coming to present to the members of the committee as part of that oversight role. So I don't know if there's anything I've missed, colleagues would add anything, but I think hopefully that has addressed the kind of 4 points, but please let me know if you've got any further clarifications.
Could I? Something?
You may. So David and Betty.
So I think I'm not going to talk about the two versions of the business plan. I think Alice has explained that. In terms of your first question around budget, I think it is worth noting, and I know numbers can be manipulated. I'm not an accountant. I wouldn't want to denigrate accountants, but if you look at the budget for doing this, and Nathan described it as a fairly monumental thing, it's about 5% or 6% of the total budget for WPP on an annual basis. So although it's a big absolute number, almost £3 million for this financial year, the cost of managing 25 billion and hopefully to be 30 billion pounds of assets, it does cost money. And I think the reason I mention that is because in looking at other pools, there are different ways that they've been set up. We've set up, actually, the plan is to set up quite a lean operation, at least initially. So in terms of the number of employees of this investment management company, will be relatively small, as opposed to some of the other pools where there might be 150, 200 employees. Ours is much more in the, let's call it, low 10s or 20s. Now, so it just means where the numbers will appear. So, the more stuff you do internally, clearly you have to employ people, and there's cost there. The numbers for the external costs will go down. So I think, as Alex, that's a long way of saying we just don't quite know yet because it depends on how it evolves. So that was just that one point. The second thing is the government's consultation response is very clear in terms of they expect and require implementation decisions to be taken by, effectively, the FCA regulated investment management company, but strategic decisions to be taken by committees like this one and the board and so on. Now, yes, there's a grey area between what you describe as strategy and what you describe as implementation, but I think, from my perspective, I think that the role of this committee, the role of pension boards, will actually be strengthened because of that clear demarcation, and also the legal agreements that Alex mentioned. So the board of a company, as you know, has a fiduciary responsibility to its shareholders, which is actually much stronger than the sort of, I think our chair described it as stately arrangements that we have today, which, yes, have been working, but haven't necessarily been underpinned by sort of corporate law and company law and that sort of thing. So I actually think that governance arrangements should be stronger and better. So I'll just add that. Thank you.
Betty.
Yeah, I would say I agree with a lot of what David just mentioned, and I think actually having a blend of still renting parts and then adding your own team is a really interesting and possibly very powerful combination, because it also can mitigate a lot of empire building, which can happen at other firms, which is very expensive, and also sometimes can erode your ability to exercise really active governance, whereas if you are kind of renting this and everybody can be replaced, I think it keeps them much more focused on serving who the real customer stroke owner is. And the other thing I would say is that it's very hard to benchmark costs versus what was done, 8, 10 years ago, because also these were not set up to also provide any kind of investment advice. So even the existing ones are having to add capabilities, because that's not how they were initially set up. So it's not apples to apples. It was a long time ago in different parts of the world. I think a more interesting comparison might be how much we're paying, it's costing us versus the Northern Pool. I don't know if they'll be sharing that, but that would be an interesting thing, because you're doing something more similar at a similar point in time.
Okay, thank you both. Does that satisfy the questions, David?
Yeah, I think a certain amount it remains to be seen, and that's understandable, but it's helpful to get some of that perspective in relation to that. And I suppose the only other observation would be, I guess it's also trying to learn lessons of where there's any comparable elements being done. I'm thinking of the CJCs, for example, where you've actually got sort of set up various scrutiny committees for what's essentially a pooled arrangement across a number of authorities. So, but with a directly employed staffing. So I'm not sure there's not much of a model there, but I just think it's one of the things just very quickly to look at potentially down the line.
Thank you, David. Ethan has indicated, but I'm mindful. John, is there anything else you'd like to add? No, happy. Ethan.
I just wanted to ask about that fiduciary advice because your response was quite robust in suggesting that you thought that should be conserved for this layer of the administrative authority. It seems that whatever got lost in translation, or at least the interpretation of the government's policy, is now that a lot of that is shifting. As Betty mentioned, they're hiring. Was there any, in terms of WPP, will that be a goal to have that full fiduciary advice piece, or because of our and their response, will that be a kind of a later stage?
I'm more than happy to defer to you to answer that question.
I think what I would do is draw the distinction between consultation feedback in the context of this is what we think versus what we're now very clearly being directed to do. I think you're right. The consultation, there is concern about, from an administering authority perspective, there's some concern about handing over investment implementation and advisory all as one package, all in one go, given that we've got very tight time constraints. I think largely that was the feedback of the group. Not speaking for colleagues, but a number of the Welsh authorities have a blend of using independent advisors, as we do. Others use investment consultancy firms on a retainer basis. So there's very much coming from slightly different perspectives there. I think what's become clear through the way in which we built our business case, the engagement with the government, is that they very much expect us to provide that investment advisory from day one. And as David has talked about, we have proposed a relatively lean target operating model for day one, with ambition to develop that as we see the value add over time. So still to be determined exactly what that day one investment advisory piece looks like, but there is an expectation that we will embrace that to the extent that it's a service that the pool company will provide to the underlying administrative authorities.
Just to comment again at the end then, I think my reflection on the process, I mean, again, to begin with, I think sort of, I'd like to thank Alex, David, Lewis, Lisa, everybody else, then Joanne and everybody else for like backfilling for the work they've been doing over the last couple of months, because it's ended up sucking up a lot of time and energy. But I do actually think we're in a relatively good position, and we've taken quite a sensible approach to this. I think actually setting it up on the sort of smaller end of the sliding scale in the first instance, but with the flexibility to grow, to get bigger over the first 18 months or 2 years is probably the right place to be. And again, referencing what I said earlier on, this is where it's going to be quite interesting where that sliding scale ends up between internal versus sort of contracted capacity and capability with some of the existing managers that we have, although in a new world we could, who knows what's going to happen. That's not me threatening anybody, any of the managers watching at the moment. But there is a reality here that we also have to be mindful of. We are setting up a company that will be an independent legal entity on the 1st of April. So actually, what again I've been quite clear, as have some of the other chairs, we can't over-engineer this too much, because at the end of the day, we are creating a company that we want to start on the best foot forward, and we actually want to ensure that we maintain as good, indeed as close a relationship as possible with this new company, and not end up maybe like some of the ill-favoured pools in situations where relationships between underlying funds and the pools have been a little bit scratchy. So I'm confident that we can get there. And I said this is exciting. Whoever thought that we'd be saying that the pensions reform was that exciting? But there is, like I said, there is a real opportunity for us to create a new public institution, to be setting the pace within Wales, but I think crucially across the UK, but also I think we have to have greater aspirations about setting up an organisation that is respected globally. I think the one thing I was going to mention earlier on, but I didn't do, there is no guarantee that Wales will stay as an independent financial institution forever. So I think one of the challenges that we have to interpret from the government allowing us to continue as a WPP, but to evolve into a different entity, is everything that we said we can do about setting up as a centre for financial investment excellence, for being open to working with others, for thinking about how we operate globally, we've got to be doing on day one, because who knows, there might be a review in 5 years' time, and if we've underperformed in actually turning ourselves into that institution, there is nothing to stop this or any other government from abolishing us or forcefully merging us with other pooling arrangements in England or other, but who knows where they might be. I don't have a problem with England, obviously. Right, what I'm going to suggest is, Aoife.
Sorry to take you down from the woods down to the trees again. Apologise.
I'm in the sky. Yes,
it was wonderful. I enjoyed it. It was more just a question that came up from the Waystone report. Am I getting the name right? That page 98, where they talked about there were two new funds that were being recommended by Russell, where there seemed to be due diligence was not sufficient done, and it seemed to create a delay. I think one is DNCA, and the other one was the replacement for Western. I don't know whether that's just a kind of because we will clearly still be relying on these partners going forward, whether there's a miscommunication or something deficient in the case of Russell, that we're not getting the due diligence required by the operator right, and because that might just involve some time out of the market. I don't know.
Again, happy to defer to you.
Page 98 was where they talk about these new additions. Twice that there was due diligence was insufficient. Due diligence was insufficient.
Yeah, I'm not clear on specifically what those issues are. Ethan, I'm just looking at the page you've referenced. I think these manager changes are largely operational due diligence changes that Russell have the mandate to basically proceed with. So the issues will be between Russell, Waystone, and Northern Trust, and it could well be an operational due diligence point. We can pick that up and revert.
Yeah, well, I would just add that there wouldn't be time at the market because this is replacing a manager within a sub-fund with another manager. So it just means the manager that they think is less good continues for slightly longer. Okay. But you're certainly not out of the market.
Betty.
But it does raise another point, and that's kind of, I thought about this on page 128 and 129. This is the WPP report. It talks about launch date and then review date. A lot of these review dates, some are planned for 2025 and some are years ago. And I'm not privy to a lot of the WPP stuff, but I've never seen any, robust review of the performance of all the funds by a third party. So it's not like Russell grading its own homework, and I think that's long overdue. And I've been focused a bit on the fixed income side, and I think scrutiny of how any of these managers are performing by someone who's not the manager we need to build that in.
I agree with you 100%. I think actually we can take that away. I don't propose we can go to the voting after this. But no, I think that's something that we've spoken about that in the last couple of months. So I think we need to ensure that it's one of those issues that are hot-wired into the mechanisms of the new organisation. We'll go, Dave, if you're very quick.
Yeah, just very quick. I think these are formal review dates which are planned by Heinens. So it is an independent third party. Heinens is the oversight advisor to the WPP. As you know, there is kind of continuous, let's call it informal review, and we're talking to the managers on a quarterly basis. And obviously the responsibility for these reviews will change. But again, the oversight of it by this committee and others shouldn't change, and we should still have transparency into those. So I do know, for example, the UK Opportunities Review, which says plan for 2025, has been completed. We just haven't seen it yet. But I was talking to Heinens about it last week. So.
Thank you very much. Now, actually, I'm looking at Andrew here. What I'm going to propose is that we actually take a vote on item number 8 first, so we have essentially endorsed the future, and then come back to endorse item number 7, which allows us to vary the business reform. I'm not endorsing the past, which allows us to enough of your noises off whilst I'm speaking, which will then allow us to do the correct recommendation if you're happy with that. In which case, then, John, David, can I direct you then to the recommendation, which is a 5.1 on page 135. So those recommendations are that we note the contents of the report and then, subject to the approval of the JGC on the 4th of June, which was given, that we endorse this report to Torrey and County Borough Council for approval at the next, well, it's not the next, it's the next but one meeting on the 22nd of July. Happy with that? Excellent.
Can I just make sure I'm on the right page, please?
Yeah.
Okay, thank you. Yeah.
Physically or sort of metaphysically?
Well, probably both.
Probably both.
There's a lot of stuff here, but
I'm still in the clouds, as I've said, yeah. Is that fine? Yeah, great. In which case, that's done. And if we can jump back, sorry to be a pain, to page 84, and that recommendation is at paragraph 9.1, and I've got to find it as well. All amongst yourselves. Recommendation of item number 7.
Yeah, page 84.
I know, I want to read it. Thank you, Joan. Right, recommendation is at paragraph 9.1. It's recommended that 1, we note the content of the report as well as the respective appendices, and subject to the approval of the Joint Governance Committee on the 4th of June, which was given to approve the varied WPP business plan for the period 2025 to 2028. Happy with that? Yep. John, amazing. All done. Well done, everybody. Moving on then to item number 9, which is on page 239. This is the risk register report, which is back to Alex.
Thank you. A bit of a break from investment and Wales Pension Partnership for a couple of moments. Another standard quarterly update that I'm hopeful that the Pension Committee are familiar with by now. This report, in essence, sets out the work of fund officers and the support of the local pension board in reviewing the fund's risk register through the latest quarterly period. As I say, officers work on this behind the scenes throughout the reporting period. We take the document through the local pension board in their role as oversight of the scheme and best practice, and the pension board do often inform the approach that we take and the output that subsequently finds its way to pension committee. As a reminder, the fund maintains its own risk management policy. We also have the document that is in the appendix today, which is the risk register. And the risk register itself has now been split largely as informed and supported by the pension board into a 2-tier system, which splits out your strategic sort of dozen risks alongside a number of underlying operational risks. And I guess the way we think about that is the operational risks drive a lot of the day-to-day activity, or the activity drives the risks associated operationally. And in aggregate, a number of those operational risks can contribute towards strategic risks that we clearly need to be ensured that we manage appropriately so that the fund does not get exposed to any of the outcomes, such as reputational or financial or otherwise. The version that you see today has gone through that comprehensive review. When I talked about the 2-tier a moment ago, what we agreed with the committee and per the policy is that at least annually, the fund officers would bring forward the risk register inclusive of those operational risks so that members continue to have that oversight. And as a result, there is quite a comprehensive document that is in the pack, sort of starting on page 243. But as opposed to running through all of that detail, and I'm happy to take any questions, I think what I propose to mention is sort of the substance of bottom of page 240 into 241. So as ever, the risk register is reviewed. Risks, any comments and changes to risk, the risk approach is sort of highlighted in red text. If we feel that there are risk score changes, you will see those highlighted yellow in the document itself. In order to try and make this a bit more of a digestible document, and I appreciate it's very hard to read the detail in the current form, we have introduced almost a risk in theme approach. And the idea behind this is that we take something topical that's happening within the LGPS currently, or potentially even wider in terms of the market. And what we try to do is use that as a reference point for how we think about risk management. And we have an item in the exempt session which covers triennial evaluation. Given that we're in it, despite all of the LGPS reform, we are in a triennial evaluation period, so it's also extremely busy from an administration and a governance perspective. But what we've tried to do here is we've reviewed a number of the risks in our documents and have made some changes or proposed changes as a result of work running in parallel, particularly with reference to evaluation. There is a document beyond the risk register. I'm just looking for that reference. So page 257 and 258. I think rather than run through the risk register document itself, which is largely there for information, I would just signpost these sort of summary changes that have been made. So there are a number of risks identified. You can see on the left-hand side, for those that have got a colour copy, that strategic risks are in red, operational risks are in blue. We've identified a number of risks, sort of half a dozen in Table 1, where there have been some control measure updates. If I take a couple of the examples around things such as SR6, which is insufficient fund cash flow to meet liabilities as they fall due. Clearly, one of the reason that we are here is to pay pension benefits. If we don't have enough income to support the cost of those monthly pension payrolls, then the fund has to force sell its assets and find other means to run operationally. So that's a key consideration. Now, we'll talk a bit more about how that would impact if you change some of the valuation methodology, or if the level of contributions that our scheme employers pay fluctuates. But in essence, there is a safeguard around this, which is the support of Hymans Robertson, as well as our independent advisors, to provide detailed modelling around our cash flow. We have had a cash flow analysis produced just in the last couple of weeks, not got to the detail yet, but what we expect is through the controls that are in place, that will help us to manage the risk of effectively running out of cash to meet those obligations to our pensioners. So that's maybe a bit more of a granular example. Page 258 then just demonstrates some practical changes to some of the risk scores. I think what we've been mindful of, having undertaken this review in the last sort of 3 or 6 months, is that there perhaps are a number of risks that we've overstated some of that residual impact. Some of that, I think, it's been helpful to have new people join and sort of some internal challenge of that. But we've also used, as I say, those reference materials, being the scheme actuary advice or independent advisor on the investment side for advice, that have helped to support those changes. So you can see there are a number of sort of modest but positive, we believe, changes to risk scores as a result of the work that fund officers have done and as discussed with the local pension board in April. So I'm happy to pause there in case there are any questions or any comments on anything that I've presented, Chair.
Thank you very much. Ian, as you're here, is there anything in particular that came up at the last board meeting this was looked at that you think is useful for us to have flagged?
I think all the comments that were made at the last board meeting have been incorporated into the update you have before you today.
Excellent. David.
Yeah, apologies, Chair. I think the only thing that struck me was that I'd like at the, I think it's the risk at A3 on page 258. You've obviously reported in the administration report some of the measures you've taken about backfilling for staff. Well, that's obviously part of the mitigation of risk and could be commented on as such in the risk element. It's just trying to match things up. That's a small point, but I think it just makes it a bit more robust.
Good point. Ethan.
I suppose just in terms of the direction of travel of many of these risks, whether we see with the recent consultation response on policy and any risks have increased or mitigations are no longer sufficient, just whether it's a dynamic thing.
Alex.
It is dynamic. I would say that's very much something we're looking at. I should have said at the start that actually, having brought David on board, that we're reviewing some of the, really around the edges more than anything, but we're reviewing some of our approach and the way in which we think about some of these risks, which we'll obviously bring back through the board and the committee. At this stage, I would say we haven't really specifically addressed any of the very recent reform in terms of what that looks like from risk control and risk mitigants, but that's something I would expect us to update the committee on later in the year as that comes more to life.
Anyone else?
Of course, one big risk mitigant is you're not really changing a lot, especially in terms of like how the funds flow. You're changing contractual arrangements, but the custodian's the same, so you're not actually moving a lot of things. So that reduces some of the risk.
Good Right, thank you very much. Continue. Was that it? Right, in which case you said you were going to pause. I thought that meant you were pausing. I thought that meant you had more to say. If everyone's happy then, and nobody has any more questions, can I point members to recommendations in paragraph 6.1 on page 241. It's just one recommendation, not plural. That the Pension Committee notes the updated risk register and the key updates implemented during the quarterly review. Chaps, David? Yeah.
Yes, happy to know.
Fantastic, thank you very much. Item number 10, back to Joanne. This is elected member training, starting on page 259.
Thank you, Chair. Pension Committee members would be familiar with this report. So the first part of the report just discusses members' training logs for the year 24-25, and this is available in Appendix A. If there are any training events that members have attended that are not recorded, then please let me know and I can update that. At this time of the year, what we present to Pension Committee members is the annual training programme, and this is available in Appendix 2. Within the programme, there are suggestions of training events that Pension Committee and board members can attend, and that take place in the forthcoming year. The training plan is intended to ensure that a broad range of topics are covered and that members can address any knowledge gaps and training is delivered in a timely manner. In addition to the annual training programme, we also do have Lola, the online training academy that's provided by Hymans. So I'd just like to encourage you all, as per usual, to participate in Lola as and when you can. And also to draw your attention to a live session that's being held this Friday through Lola. And the topic that's being covered is effective decision making. So you should have all received an email about this. If not, please let me know and I can forward on the details regarding that. So, you know, if you're available, you can join. But I believe they're also going to make a recording of it, so you could follow that later if you wanted to. So if anyone does have any additional training that they would like to see in the annual training programme, then please let me know. And we can update that and ensure that all the training that members require is covered. And that's it for me.
Thank you very much. I'll take Ethan.
Sorry to make a shameless plug here. Part of the reason I think that some of the macro context is quite dynamic and changes. So just to make people aware, I do what I say here. I record weekly. I have one loyal follower in Lewis. I have more than one follower, but Lewis is a loyal one on my YouTube channel, and the link is in my report. Just it's market context. It's just how to interpret the backdrop for institutional investors. Some of the panel may find it useful, but equally, for example, during the tariff kind of Armageddon, I did about 3 in a week. So sometimes it needs a bit more dynamic. So.
Happy to advertise, but we need to have a conversation about how we marketise that to our benefit. Any other questions? In which case, good work as ever, Joanne. Right, members then, page 260, the recommendations at paragraph 5.1. Recommended that the Pension Committee notes the annual training programme included in Appendix 2, considers whether specific training areas or topics should be included. Are you happy with the report? Excellent, thank you very much. Right, always my favourite bit of the meeting. A date of next meeting to be confirmed. I think Jade will confirm the Chamber availability before selecting the next date. I think just a bit of background to this, there are some issues dancing around about meetings in the Chamber, but also it's the Labour Party conference, so I can't be in 2 places at once. So we're just trying to work out what the best date might be. It could maybe creep into the very beginning of October, but we should be able to tell people ASAP. That's right, isn't it? Yeah, fine. No, this is the bit I love every meeting. Here we go. Item number 12, the exclusion of the press and public. It would be good if we found somebody who had an understanding of punctuation to to write these things. Right, so to agree the exclusion of the press and public from the meeting as presentations and meeting papers are not for publication because in accordance with paragraphs 12 and 14 of Part 4 of Schedule 12A of the Local Government Act 1972, as amended by the Access to Information Variation Order Wales 2007, it contains information about a particular individual and information relating to the financial and business affairs of particular persons, including the Council, and in all the circumstances of the case, the public interest in maintaining the exemptions outweighs the public interest in disclosing the information. Members, are we happy to exclude press and public? Certainly, thank you very much. Thank you very much for closing the door, Jade. As ever, I'm happy to allow members of the board to stay to observe the items under discussion. I'll wait for Jade to make it back from closing the door to closing off the camera, closing off the recording equipment. Thank you very much, everyone.